Hello, and thank you very much for joining us for the quarterly market update. We're going to be talking about 2022 first quarter market returns. I'm with my colleague and our founder, Peter Watson, today. And we're going to be discussing what's happened this past quarter in terms of the markets, as well as looking at a little bit of a longer term perspective as too. And we're going to be trying to frame all of our discussion today in terms of what the markets mean for our clients and all of our prospective clients as well. So any additional tips, insights, we're going to be looking at it all from that particular lens. And then we're also going to be adding in extra tidbits around the inflation, interest rates, and the war and stock market. If you are not a client and you'd like to connect, please feel free to use a link that's going in the chat box for booking a free consultation. You can also always go to the homepage of our website. In the top right, there's a free consultation button. That's to schedule a meeting with myself or somebody else on our team, and we'd be happy to have a meeting with you. For any of our clients, if you have a loved one or a friend that you think could benefit from having a conversation, please feel free to send it to them at any point in time. We'd love to hear from your friends and family.
Well, thank you, Jen, for that introduction. So let's get right into the numbers, the numbers of the last quarter. As you can see from the arrows, it was a pretty not so great quarter. 6 of the 7 asset classes were down reasonably significantly, sort of 6-8% kind of range. The only saving grace was actually the Canadian stock market. It was up about 4%. I'd like to use those arrows as a bit of a learning opportunity to see sort of what happens over a longer period of a time. If you look at the bottom part of that area that's been highlighted in red, the best quarter for Canada since the year 2001 is 20%. So 20% 1 year, or 1 quarter, that's a great quarter. But it also had a worst quarter and it was down 22%. As you know, for those of you that have tuned into these webinars in the past, we always like to highlight volatility. Markets go up and markets go down. That is normal. That's to be expected. But we hope with good, strong diversification that's not influenced by what the market did yesterday or last month. We hope that people have a long-term strategy, and our clients do have a long-term strategy, and we stick with that strategy. Now, something that Jen, I think I'd mentioned this earlier. One thing I'd heard yesterday, saw in the Investment Executive, which is an industry newspaper we read online, that Canadians were starting to dump their foreign stocks. I guess Canada's going up, so you got to change things. That's historically been a very bad strategy for people. Have a strategy, things go up, things go down, and stick with your strategy. Don't try to sort of outguess things. That tends to be expensive. Looking at Canada, I said Canada was the best over the last quarter. Let's come down to the bottom part, looking at 10 years. So we've got 1 year, 5 year, and 10 years, but I want to focus on the 10 year. Canada has had a positive return, the Canadian stock market, of 9% average every year over the last decade. That's pretty good. But look next door at the US market. They've had the same over the same 10-year period. Their numbers have been almost 17%. Our strong belief in diversification means you have some of your assets in Canada, but you do not overweight the Canadian portfolio. For example, Canada accounts for 3% of the world economy. If you add up all the publicly traded stocks in Canada as opposed to the publicly traded stocks elsewhere, we represent about 3% of that economy. So to have too much money in such a small sliver of the world economy is not using diversification. So expect that there will be ups and downs quarter to quarter. Some quarters, some sectors will be performing differently, but have a balanced portfolio, have a long-term approach, and just know that the ups and downs are part of investing.
Now what we're looking at on the screen is the world stock market performance. Highlighted with the larger graph is looking at just this past quarter. And then in the top right-hand corner, what you can see is a year outlook. and with the last quarter being highlighted at the end there, and we've marked it in red as well. So what you can see and what you know from living this past quarter is the fact that there was a lot of very important news headlines, and a lot of things have been happening recently. The unfortunate war with Ukraine, Russia. We have interest rates being hiked for the first time since 2018. We have gas prices increasing. It's been a lot, and investors are curious how this is going to impact them. Well, when we're looking just at the investment, so just at the stock market and from a world perspective, which is what we have on the screen here, what you see is there was a decline in the past quarter compared to the previous months before. But we haven't seen any significant dips like we have in other very memorable, and most recently March 2020, where we had a very significant dip. Now, we're going to address what these different topics and headlines mean and how it can affect you and your portfolio more specifically in just a moment. But first, let's go to the next slide and we'll take a longer term look. Again, we're going to be looking at the world stock market, but now from a 22-year time period. So what you see on the screen here is over 22 years, how has the world stock market performed? Well, you can see there's movement, there's that volatility, that ups and downs we get from the rigid lines. But overall, when we're looking at it, you actually see the line continuing to increase over the long term. If we were to actually take a year outlook, or sorry, 100-year outlook of the same information, what we would see is a very, very similar line. It means that there's movement on a daily, short-term basis, but overall, the equity market has continued to always incline. And with that incline, that is one of the things that we can actually remember and help us when it comes to inflation. So speaking around inflation first, and then we'll go to interest rates next. So inflation, what's really important there is to keep in mind your spending power. And that's what's really is the key. So how is inflation going to affect you today, and how is inflation going to affect you in the future? This is something for clients, this is what's embedded in your cash flow projections. We've, in even years where inflation was not really a massive topic, we were discussing it with you and we were putting it into the cash flows. And that was a factor in determining your overall investment mix to figure out, how much money do you actually need and want to spend, and what's that minimum we need just to keep up with inflation alone. So that's something that's really important. It affects our spending power. In the short term, how it can affect us is, well, things are more expensive potentially right now. And if we go and get really granular, you'd actually separate out the inflation into all the different categories that make up the overall inflation, and you'd see where you're most impacted. So for example, new car sales, that's one of the highest areas we've seen in inflation this past year. So is that applicable to you this year? Is it not? And now how is this going to affect your saving abilities and your spending abilities? So baking that in. Now, when we looked at that longer graph of the equity market, what we saw was that continuous increase. That is going to be having money in equities, as long as you're in the right diversified portfolio that makes sense for you, in the right sectors, in the right countries, then that is going to be your biggest tool for growing and preserving your wealth and preserving your spending power, which is ultimately one of the most important things when we're looking at money for the future. In terms of interest rates, now interest rates have also, as we mentioned, they have gone up. They've gone up now for the first time in a very long time, and they are expected to continue to increase. And what we see there is in any debts that you have, those are going to be affected. So if you have, let's say, a mortgage, it's a variable rate, you're going to be immediately affected. So your immediate cash flow is affected, how does that impact how much you can save for the future? For any fixed mortgages, you're not going to be affected right now, but you know it's coming. If you are borrowing for the purpose of investing, or you have a company and the company has borrowed assets, now we want to think about, and we've always wanted to think about this, but now we have this changing landscape with the rates increasing. We want to think about the cash flow. We want to think about now the return that we need to actually be that much further and above the interest, to warrant the interest rate that you're paying. So these are some of the considerations, and these must always be an ongoing conversation, and not just in years where this is really impacting us, but actually even before, because we want to always be making plans with the idea that interest rates do go up and they do go down. Inflation does go up and inflation does go down, and that has been a historical the norm, really, of what we see. And later on, Peter's actually going to show a graph that really highlights this a little bit further.
On this chart, we'd like you to focus just on one thing, and that's the colored lines that start on the left and go to the right and on an increasing scale. What those lines represent are different asset classes, as Jennifer mentioned earlier, in terms of things that we do and things that we want to look at. We want to look at your individual circumstances to see how your portfolio should be constructed. Should you have growth investments, perhaps stocks? Should you have income producing investments, perhaps bonds? Really what most clients want is a very good collage of different investments, because they have specific needs, and that the weighting of investments is basically dependent on what your needs are. What you will see in those lines I'm asking you to focus on are, there is volatility. So sometimes they're up and sometimes they're down. If you were to look at a larger scale to see, which line was which asset class, the one on the top is stocks. That's the equity, the stock market. The stock market over time has historically and logically does do better than a bond. There is more uncertainty with stocks. There is more volatility. And if you can see it towards the end of that top blue line, see how that's March when COVID hit us 2 years ago. See how everything just went down, particularly the stocks, the blue line. So that's just normal part of investing. And if we expect that's normal part of investing, when the highs and lows happen, that's just to be expected.
So what else we can highlight on this slide right now is, let's take a look at the last 3 months, and for the different mixes between 100% equity all the way down to 100% bonds. Now, what we want to show you here is what's happened this past 3 months is actually showing what we would expect to see in the long term, not necessarily in the short term, but we would expect in the long term, where the 100% equity portfolio had the highest return, the 100% bond portfolio had the worst return, and everything else in between was of equal scale in terms of the more equity you have, the higher expected return we would expect. More bonds you have, the lower expected return we would expect. Now, just because the bonds have a lower expected return expectation doesn't mean that there's something that should be excluded from your account. It's actually really important to have the right mix there that makes the most sense for you, again, based on what you're trying to achieve and your objectives. For our clients, we kind of range anywhere from 100% equity to the 40% equity and 60% bonds, and lots of different variations in between there. And then when we looked at that 3 month period, we can see the year, the 3 year, 5 year, 10 year, and what we see is kind of that consistent theme across of the more equity you have, the higher return, the more fixed income, the more bonds, the lower the return. But what's important to remember, and Peter highlighted this a little bit with the lines that you see below, it is the movement there. So the more equity, the more movement we're going to get. But let's remember that steady increased line that we actually do end up seeing. And if you had 100% bonds, not going to be enough to combat inflation. Probably not. Is that going to be enough to meet your spending needs? Probably not. But from an investor perspective, there's basically little movement of ups and downs. So it's really understanding that mix and then understanding how to when to rebalance the account and really understanding that volatility is expected. That is what gives us returns. So again, as long as we have the right portfolio built for clients, then clients can really withstand those times.
And Jennifer had mentioned inflation a little earlier, and the red dots that are being highlighted now, that's the inflation rate that has happened, annual inflation rate that has happened over the last good number of years, 30 years. And so a question, as inflation is becoming more prevalent, and it was announced that 5.7 was the current inflation rate as the end of February, and that's the highest in 30 years. And then this morning they released the March figures. Inflation now, annualized inflation is now up to 6.7. So a good typical question is, how does inflation impact investment returns over time? Well, as it turns out, it really has no effect, because you've seen the red dots showing the various levels of inflation from year to year. But the bars, the green bars, they show that the stock market has increased a little bit or a lot in one year, and then down a little bit or a lot in other years. So the stock market is kind of going up and down, back and forth, like you have experienced, like we have experienced from the history books for the last 100 years, and what we would expect in the future. So the answer to your question, does inflation affect returns? I'm sure there's little influences, but basically, historically, they've been two separate events.
So if we were to summarize, what would be some of the key areas for continued financial success? Well, it's to make sure that you have the right investment plan that's right for you. Clients, we are looking at this all the time for you when we're making sure that it is the right investment approach and the right plan for you. But of course, if you ever have any additional questions outside of your regular review meetings, always feel free, like you can reach out to us. And making sure you have a financial plan is also really important. And having that financial plan work with the investment strategy, the two must be connected. That's really, really important for your success. And then making sure you're working with a team that you trust and you're having cash flow projections done at least annually, which really is tying everything together: investment returns, your objectives, your lifestyle needs, inflation. All of that gets tied together in those cash flow projections. Really an important tool. And making sure you have the strategy and the process in place. Having a strategy and a process in place will enable you to make smarter decisions and faster decisions too. So as circumstances change in even your personal life or in the markets, if we already have that strategy and process mapped out, it's going to empower that quicker decision making while still making smart decisions. So that's really important. I mean, some examples could be if you were unfortunately laid off earlier in COVID. That was something that some people experienced, and now you're changing jobs. Being able to have all of the tools already in place, and for us to just relook at the numbers, reassess how you're still going to be okay and comfortable, and making sure we understand what that looks like. If you're selling a business, how is that sale of the business going to impact your future? Again, we have all the tools already laid out, mapped out. Now, when this new event comes along, we can add that into the plan and really see what that does for your future. And what you're looking at on the screen here is a sample of our financial planning priorities document. This is one of the tools we use to help with our strategy and our processes. The different categories include financial management, retirement planning, tax planning, risk management, estate planning, your client experience, and then you could also have other areas around children or grandchildren, education planning, to name a few, but everything gets customized for clients. And it allows us to really just have that clean process and strategy laid out. That's an ongoing process. This is just a picture from one of the one of the graphs that can be generated from cash flow projections. And there's a great YouTube video that we did that really summarizes more around the power of those forecasts. So you can find that on our YouTube channel. Just go to YouTube, search Watson Investments, and then it's the power of financial forecasts. Also, the link to the video is gone in the chat box. And we'd like to stay connected. So we have Instagram, YouTube, Facebook, and LinkedIn. So please feel free to follow us on all those platforms. Sign up for a free consultation if you would like. We would love to hear from you. Clients, please send that to somebody that we can help. And our newsletter, if you don't already get our newsletter, please sign up. There's a sign up link in the chat box as well. You can always find it at the bottom of our home page. The newsletter allows you to get articles that have been recently published, up to date on current information, and invitations for future events. A reminder about tax filing deadline. So tax filing deadline is quickly approaching us. It's May 2nd for personal returns. Tax filing deadline is do it on time. It's very important. It's also important that all the tax planning items are executed now at the tax filing stage. And we wanted to talk just for a moment about the difference between tax filing and tax planning. So some of the tax planning does get executed at the tax filing time. Those are things that can include pension income splitting. Perhaps a more complicated scenario would be if you've made an RSP contribution in, let's say, the 2021 tax year, because that was your next best tax sheltered vehicle to put that money to invest in that tax deferred basis. But you know, in 2022, your income is going to be significantly higher. So we've decided, put in the money there, let it grow in that tax sheltered environment, but don't actually claim it this year on your tax return. Claim the amount because we're saying that the time value of money is actually going to be outweighed by the fact that now you're going to be in a significantly higher tax bracket. That'd be one example where, the planning's been done, now tax filing time, it's just executing on the right path based on everything else. A lot of the tax planning does happen actually throughout the calendar year. So right now, doing things at this point in time, a lot has already passed that you're able to do. So make sure that your tax plan is something that's ongoingly looked at and that is and then properly executed on at the filing stage. For all of our clients, we're reviewing your tax returns as well for you, and we're also making sure that if you're a business owner, we're communicating on your behalf with your accountant for you to coordinate the tax planning throughout the year. So tax planning, lots of things there, and May 2nd is our personal deadline coming up. Our next quarterly market update is July 27th at noon. There's a link in the chat box if you'd like to register. You can always go to our website as well. The top bar, there's an events link. Click on events and upcoming events, and you can always see our upcoming events and register. Thank you so much for your time today, and we look forward to connecting with you soon.